Hi, and welcome back. Today's session we're going to take a look at bonds and bond portfolios and the role that bond portfolios play within our larger institutional portfolios. We're not going to have a chance to take a look at a lot of the details of bonds. That material is covered in corporate finance courses and especially in our fixed incomes course. In this session we're going to take a look at the sources of risk and return from bond portfolios and how those are managed. In particular, we're going to take a look at the risk management, although a lot of that material will be covered in the second video in this series. When we start to talk about bonds, we do have a very big topic. In fact, a lot of people would be surprised to know that bonds are actually the largest proportion of institutional portfolios in most cases. And that's partly because bonds are, despite the fact that we talk about equities all the time, actually a larger class of assets overall. When we think about the equities markets, of course, they are exciting. We see continual trading. Bond markets are huge on a worldwide basis. The equity market is about $32.5 trillion. About half of that trading is done within the United States. Most people would be surprised to hear that global bond markets are 3 or 4 times larger than the equity markets. And that happens for a couple of reasons. Number one, a lot of the bonds that are issued by governments. Sovereign issues in bonds make up about 68% of worldwide issuance of bonds. Also, bonds don't trade the same way. They don't trade on a minute-to-minute basis, or at least we don't have that price discovery. A lot of bonds hardly ever trade. They sit within portfolios and they basically sleep over long periods of time. And when they do trade, the trades are only reported on a daily basis. Of course, if you work as a fixed income trader for a large institution, you can actually see the trading portfolios happening in real time. But it's not something that average people get to watch. When we're talking about this debt, of course, bonds are issued by governments, by subunits of governments, like municipal agencies and crown corporations. They're also issued by companies, utilities, and so there are a variety of different issuers. A large part of the bond issuance happens on international markets, and so we talk a lot about foreign issuers. The foreign bond market is largely made up of companies that are listing and issuing in a second country market in another country's currency. For example, if the government of Canada wants to raise a lot of money to fund the development of transportation, perhaps, something that we're talking about right now, and we look at the domestic bond market and realize that if we started to raise capital locally, we could suck all the capital out of the local economy, and that would be a problem because other companies that are trying to build at the same time would be in competition with their government. So the government might decide to raise money outside of Canada on international markets in the United States, in Europe, and increasingly in Asia. Some of the of these foreign bond issues are known by a variety of interesting names. It's an interesting marketing exercise. For example, if a foreign company decides to raise bonds in the United States, let's say Canadian government or the province of British Columbia decides to raise funds in the United States, denominated in US dollars, those would be Yankee bonds. If they decided to raise funds in Japan, denominated in Japanese yen, those would be samurai bonds, and so on. We've seen things like Matadors and Bulldogs and Bunds and Rembrandt bonds. There's some new and very interesting markets that have developed, like the market that's called dim sum bonds. Well, yeah, if you know dim sum, that's a type of Cantonese delicacy, very popular in Hong Kong. So that's kind of a giveaway. Dim sum bonds are bonds that are issued and traded in Hong Kong typically, but they're actually denominated in renminbi. This was the first opportunity to open up the markets of China, and trading in Chinese currency denominated instruments actually happened originally in Hong Kong. And you can see that if a Canadian entity wanted to raise funds denominated in renminbi, it would go to Hong Kong. In this article from the FT from a few years ago, it essentially says, well, British Columbia was looking to raise funds denominated in renminbi, bonds that were sold by the province of British Columbia and would be repayable in renminbi in order to raise funds without diluting the availability of capital in our own markets. And you can see that those bonds have become very popular. We also have American companies that want to raise money in Canadian dollars. For example, if Walt Disney felt that they were going to earn a certain proportion of income in the future from Canadian customers, they would have foreign exchange risk. Well, by matching their liabilities and their assets, they could have neutralized, or we say immunized, some of that currency risk. So Walt Disney offering to sell bonds denominated in Canadian dollars to Canadian investors, but also to other international investors as well. That's just a quick introduction to how some of the marketing might work, and we'll look at some of the other tools that are used in a couple minutes. Essentially, some of the things that we need to consider in this video, we'll take a look at how liability and index benchmarking works. In other words, how do we match ourselves to particular liabilities that we have, or to a benchmark, a broader benchmark of bonds, and determine whether we're doing better or worse, how we're doing things differently. We'll also take a look at some specialized financial instruments called repurchase agreements, or repos, and the things that go into actually helping us to understand how the repurchase rate works. We'll talk about immunization. Very interesting in this time of pandemic that we're talking about immunization. How do we vaccinate our portfolio against certain specific risks, like interest rate risk, or perhaps in some instances also things like credit risk? We'll look at rebalancing our portfolio using tools like dollar duration and spread duration. We'll look at those in a couple of minutes. We'll take a look at portfolio risks, and then largely in the second video we'll take a look at the use of things like derivatives and a little bit about how international portfolios and risk management works. Now, I know that this diagram is going to be a little bit difficult to read. You can see that, well, first glance we've got essentially an order in which we're going to perform our management tasks, setting objectives, and then below that developing our portfolio strategy, implementing the strategy, and monitoring and adjusting. Those are things that happen as we move down the chart. As we move across the chart, we look at two special cases. We have the type of general bonds, and then in that little tree over on the right hand side, we have mortgage-backed securities, or MBS. We're not going to be looking at those quite so carefully in this session. As I say, they tend to be a special case. I'm not going to go through this step by step, but you can see that we do have to determine things like how we're going to set up our benchmarks, how we're going to manage our funds against those benchmarks, different strategies or approaches for doing this. We'll go over some of those as we go through this session. Now, there are two main pressures that we have to perform. One pressure is a general one to do better than other fund managers. But as a fund manager, working with a particular company, I'm also particularly interested in managing my returns against my liabilities. Certain liabilities we've seen before include things like life insurance policies that have to be paid out, or pension liabilities that we have to cover. So those liabilities could be our key benchmark, the immediate bills as they become due. Portfolio leverage might be part of this, and using our bond portfolio to be able to create leverage to using a combination of borrowing and investing to try to improve our overall performance against a benchmark like the risk-free rate. Covering some of those legal requirements, making sure that we can cover our cash flow requirements, paying out insurance policies or paying out pensions. If this is the case, then our portfolio is successful as long as we're able to pay our bills to meet these liabilities. So liabilities are both the objective of the portfolio and the portfolio benchmark. A second way of looking at this would be to say, how well are we doing compared to other portfolio investors in this particular segment of the market? We can need a benchmark based on an index. And we have several different indices that have been produced for American bonds, for Canadian bonds, for global bonds, produced by organizations like Morgan Stanley indices. Standard & Poor's produces indices for different types of bond obligations and so on. If you're an organization like a mutual fund that doesn't have specific liabilities to meet, this would be the most reasonable type of benchmark to use. Now, without that cash flow constraint, the particular liabilities that we have to match, you have more freedom to invest. And so in this case, we'd be more likely to use a bond index than a liability benchmark. This is an exchange-traded fund that is based on one of those benchmarks. It's called XCB. It's issued by BlackRock, essentially traded over the counter as an equity, but the returns are going to be based on an index called the DEX index. Essentially, the DEX index is an index of Canadian bonds that are principally corporate. And so if you take a look at the components, it includes things like banks and utilities and corporate bonds that have been issued. It's interesting to see how BlackRock has put together an exchange-traded fund based on bonds, because bonds are notoriously difficult to get information about. And when we don't manage to exactly track that index, we get something called tracking error. Tracking error for a bond ETF or for any bond portfolio is something that's likely to occur because we can't actually hold all of the bonds that have been issued. There's a higher transaction cost to buy and sell bonds, so as the market changes, we would have to continually be buying and selling bonds. And not all bonds are liquid. They don't trade on a regular basis the way that equities do. So even if we have a smaller sample of the index, then being able to buy into the full index of all issued Canadian bonds, we would still have difficulty tracking it. So tracking error becomes a problem because we can't fully replicate, can't copy all of the bonds that are traded. We also have certain management expense costs of managing that portfolio, the transaction costs, the monitoring costs, and so on. And we describe that as the management expense ratio, or MER. At 40 basis points is actually pretty cheap for an ETF. Essentially says that 0.4% is the cost of running that ETF, and that's going to actually reduce the returns from actually owning the whole index. On top of that, we have about another 40 basis points of tracking error. So we're not quite following the index perfectly. It would be relatively easy to do this for an equity ETF. For example, a sister ETF of XCB is XIC, which is a Toronto Stock Exchange Capped Composite Index. And it's relatively easy to buy the 170 or so stocks that you need in order to make that index work. Almost zero tracking error, and the management expense ratio is a lot lower at only about 20 basis points. Another approach would be to do pure bond indexing. In other words, we're just going to hold the whole index. We're going to buy everything. Unfortunately, it's going to be difficult to do because they say full replication is essentially going to be impossible. The next step, if we can't do pure bond indexing, is to do something called enhanced indexing. And that just means that we're going to sample parts of that portfolio. We don't actually have to buy all of the bonds in the portfolio, but we have to identify what the key risk factors are and match our portfolio risk to the risk of the index. So for things like duration or credit spread or the issuing time of the bonds, we're going to actually get a certain sample in each of those groups that will match the overall index. So we describe those as the primary risk factors. Interest rates are going to affect things like duration. Change in the yield curve happen because of change in the time in which the instruments are going to be due, and also credit spreads. the different credit ratings of the average stocks in the portfolio. So we use sampling. We sample a certain proportion of the stocks within the portfolio and try to track the entire index. Essentially, we say that we're not going to get this perfect, but we're going to get it right on average. Any major macroeconomic changes, a change in the interest rates, a major drop in economic activity, is going to affect the index the same way it's going to affect our sample. How would we do that? Well, this particular index, or this particular flowchart, again from the textbook, Chapter 6, takes a look at the different types of risks. And, well, we're not going to look at the mortgage-backed securities. Those are a special case. They have different kind of risks. But if we just look at the non-mortgage-backed securities on the left-hand side of the chart, you'll see that the type of risk includes interest rate risk, yield curve risk, the credit spread risk or spread risk, the specific credit risk, the risk of a downgrade or partial default, and then the risk that comes from things like call options or call provisions, any kind of special features. And so this also describes the different types of, or the different nature of the challenges of each of these things, like a parallel shift that results from interest rate changes or expectation of interest rate changes. And we would measure that with a tool like portfolio duration. And we won't go into all the details now, but we will look at those in a couple minutes. So this chart, especially the left-hand side of that chart, tends to be particularly useful for us. Now, we can try to manage our portfolio risk exposure by managing some of the key factors or managing some of the larger factors. Small risk factor mismatches essentially says we're going to match things like the duration of the index, and then for some of the other things like the credit spread or the credit risk, those things, or even the sector exposure, those things we're going to not worry about matching. We're not going to match everything. We're going to match the key factors, especially things like the timing of, or the life of that interest rate exposure. Longer exposures have more interest rate risk, and that's going to be the most important factor. So we'll allow small factors to be mismatched, but the big factors we're going to manage. We're going to make sure we're pretty tight on that one. The larger challenge would be to try to match essentially allow mismatches in all of those factors, including the interest rate, the credit spread, and so on. We do something like this in order to take advantage of what we feel are short-term opportunities from the market. If we think that interest rates are going to rise substantially in the next 3 months, that would be a good time to add extra duration risk. If we think that companies are going to see real financial difficulties in the next 3 months, perhaps we're going to take a bet on credit spreads because they tend to increase when things go badly. Or if we expect to see a lot of defaults, we could also take a big bet on that one as well. So we're taking deliberate and sizable mismatches in order to beat the market. Small risk mismatches, we're hoping to do just a little bit better than the market in order to cover our management expenses. This one, we're actually actively trying to make money. Some of the tools that we're likely to use, and we don't go over these in any detail in this course, you might hear them referred to. Things like ladder strategies, barbells, and bullets. Ladders are essentially a way of reducing the overall risk, perhaps by taking several different short and long-term bonds and putting them together, but making sure that they mature at different times. By perhaps taking one string of bonds that have all got 90-day duration and adding those to some bond series that also have 3-year duration and some that have very long durations of 5 years. They're going to mature at different times, and that's going to help us to smooth the duration exposure. Shorten the duration even though we hold a lot of longer term bonds. Longer term bonds, remember, pay us higher yield And so we'd like to still have some long-term bonds, even though we have got to maintain short duration. Another way of doing the same kind of thing is to produce a barbell. Remember, the long-term bonds have high yield, so we're going to hold some long-term bonds, but to offset, those 10-year bonds, let's say, we're also going to have a bunch of 1-year bonds. The short and the long term added together gives us a much shorter average duration, but we get the high yield from those longer bonds, and we also offset some of that risk, some of the interest rate risk, by lowering the average, by adding the long and the short. So nothing in the middle, just long and short. And if you look at it, it kind of looks on a bar chart like a barbell, or the top half of a barbell. Bullets essentially say here we're going to make sure that our portfolio is made up of bonds that are going to issue or going to be maturing at the same date, but may be issued at several different dates. Now, active management essentially says that we're going to play with everything. We're going to take our bond portfolio and we're going to be aware of all the risk factors. And we're going to be aware when we have exposure to certain of those risk factors. But we're going to allow perhaps systemic or long-term exposures to persist without any kind of specific immunization from within the portfolio. And maybe we'll try to fix that later with derivatives. So we just buy whatever we think is going to provide the greatest possible return. We have things like the DEX index, which essentially says that this is going to be the average rate of return. And this BlackRock case, we see exactly how that's going to work. We've got the return, the growth, $10,000 over a period of years, growth of $10,000. And essentially this says this is what you would earn if you're going to put your money into an average portfolio. An active strategy would seek to beat this on a persistent level. The kind of things that we look at when we're trying to think about what do we have to match and what do we have to beat. The yield, we're looking of course for the highest yield, and at certain points in time the yield is going to go up, it's going to go down. We're also looking at the duration. How long are the average instruments in our portfolio? According to this, the All Corporate Bond Index, the DEX index, has got a duration that starts off at about 5.7, perhaps improves to about 5.5, and then goes longer to 5.8. So higher yields are available through longer duration, but also higher interest rate risk. And of course, we've also got an idea of the total return. So if you buy a $1,000 bond, will that bond be worth $950, $980, or will it be priced at a premium? In this case, high of about $1040. If we're talking about using bond indexes or bond indices, we should make sure that we're benchmarking to the index with the characteristics that best resemble your firm's or your client's portfolio. Things like the market value risk. In other words, the price of the bonds will go up and down in the opposite direction of yields. So if interest rates are going up, then it's a pretty good chance that the market value of your bonds is going to go down. So the market value. That can also be affected by things like the credit spread or the credit rating for the average bond in your portfolio, because of course the lower credit quality bonds may have greater market risks. Income risks comes from the income sources, in other words, the coupons that we're going to earn, and the shorter the duration, the more risky the income risk is going to be. And matching duration of the portfolio with the liabilities is also something that we would need to talk about. Now, the enhanced indexing strategies essentially say that we are not going to try to match perfectly what's happening in the index, but we're trying to identify some of the risk factors. The portfolio duration is an obvious one of those. So if the yield curve moves because of new information about interest rates and interest rate expectations, largely a product of things like inflation, that's going to be the portfolio duration. If we have differences between short-term and long-term rates that perhaps come from short-term expectations about things like inflation and a shift in the yield curve in the short term, that could be another factor. The sectors in which we're investing, financials or corporates or different types of government bonds, for example, changing the structure of the quality based on our investments could be another factor that we'd have to manage. The duration for particular sectors within our portfolio, credit spreads, the credit quality within our portfolio. Do we have all triple B, or are we shifting towards an A-rated or a double A-rated portfolio? Have we also changed things like the sectors or the coupon, the average coupon rate of our investments, the maturity of our bonds, and how about the exposure that we have to the issuer? If the organization that is underwriting the bond is a government body, government bodies' credit quality changes over time as well. If they're issuing too much, if the quality of the credit of the issuer is suspicious, then also the quality of the portfolio will suffer. Now, a couple of other things that we need to be aware of. Total return. Of course, the overall return to our portfolio includes the capital appreciation as well as the coupon. And so for this, we're going to take a look at the effect of any kind of restructuring in our portfolio of the total return within the framework of our current guess of the future interest rates. Scenario analysis is essentially a way of taking a look at that total return and saying what's going to happen if the world changes on us. What happens if inflation increases? What happens if interest rates are cut, or if we have negative interest rates? So this will essentially feed into our model all of the different possibilities and assess the overall value of the portfolio underneath each of these cases. And if we see that we don't like the output, it's time to look back at our portfolio and perhaps go a little bit shorter on something like the duration or change the composition of our holdings. Another factor that we need to be aware of is that quite often portfolios' function is to provide leverage for other investments. Leverage essentially means that we're going to use additional borrowing to increase the overall return to our portfolio, whether it's a bond portfolio or an equity portfolio. So leverage magnifies, and that means it increases it when things are going well, and it will make things worse when things are going badly. So it's always going to be that double-edged sword, or at least with traditional leverage. If the cost of our leverage approach is going to be higher than the return, then we're going to suffer. So if our cost of borrowing is going to be greater than the return of the portfolio, leverage makes things worse. One of the tools that we're going to talk about next is something called a repurchase agreement, or repo agreements. Essentially, repurchase agreements are a type of collateralized funding where we hold on to government bonds, which are going to provide the collateral, and we borrow against that. If we have $1 million of collateral, worth of collateral, we could perhaps borrow up to $1 million using that collateral. And we're going to essentially promise to provide that collateral to the counterparty, and we're going to buy it back at a discount. The discount is going to essentially provide us with a measure of the interest rate. So repurchase agreements, because they're fully collateralized by this government debt, provides a low-cost way of borrowing for the issuers and a higher rate of return than buying and holding those underlying treasury instruments. The rate at which the repos are going to be repurchased, we're going to receive, say, 95 cents on a dollar, and we're going to buy them back for $1, giving us a 5-cent difference. So that would be the repo rate. It's just a measure of the present value of the difference between the sale and the discount rate. It'll depend on things like the quality of the collateral. So if we're using top-rate government bonds, that's going to going to be part of this. Most repo agreements are very, very short term, usually overnight, but if they're longer, the duration is also going to be a factor. If they're physically delivered, that's going to reduce the chance of default, and so that's going to provide you with a better collateral and a lower rate. The availability of the collateral. Bonds sometimes have to be reissued over a period of time, and if the government stops issuing bonds, then there's low availability of collateral. So you may get a lower rate if the underlying security is hard to get. The prevailing interest rates, the opportunity cost of capital becomes part of this, and typically because they're fully secured, we use the federal fund rate. And there may also be some other factors, some seasonal factors that are going to affect the supply and the demand for funds. Now, we will talk quite a bit, both in this section and also in the video that follows, about our strategies for protecting ourselves against some of those specific risks, against the duration risk or the credit spread risk and so on. And the generic term that we use for protecting ourselves is immunization. It's kind of like buying insurance. So what kind of immunization can we provide? Is it going to be something that is essentially contractual, or is it going to be something that involves derivatives? Things like a change in the interest rate is the largest of the large risks, large factor mismatches. And so it's going to affect both the investment and reinvestment income that we get from our portfolio and the overall portfolio value. Our immunization strategies essentially attempt to ensure or to lock in the overall return to our portfolio over a particular period of time by finding factors that are going to essentially hedge or cancel each other out. So perhaps we've got a liability that's going to be interest rate sensitive. We try to match it with an equally sensitive underlying asset like that bond. To immunize over a period of time, we need to make sure that we have got the same duration, or the same maturity effectively, of both of the instruments over the entire investment horizon, and that the present value of the cash flows is going to equal the present value of the liabilities. If we have got an immunized portfolio, and we seek to be able to rebalance that over time and to monitor it and to change it and to make sure that it's still working, the changes in our yield can fluctuate over time, resulting in the change in the duration as we move through that time. And every time we see that the benefits or the reinvestment income is going to be greater than the cost or the liability, we need to rebalance. We need to reset our portfolio. Over short periods, there's going to be some kind of a mismatch in the duration, because we can't do this on a minute-to-minute or even a day-to-day basis. So we live with some of the duration mismatch. And if interest rates are stable and if credit risks are going to be stable, then we can largely leave those liabilities unmatched over a longer period of time. But whenever we do a rebalancing, there's going to be transaction cost. And remember what we said about that tracking error? The higher the transaction cost, the harder it's going to be to reduce our match to that, either the liability or to the index. One of the things that we try to match is the dollar duration. Dollar duration essentially asks, how much will the portfolio value fall for a 1% increase in interest? A 1% decrease in interest would lead to a portfolio rise in value. Essentially, dollar duration is expressed as a percentage duration times the portfolio value. So if we have a 5-year duration and we have $1 million portfolio, 5 times 1 year times set that as a percent, multiply it by 0.01 would give us the dollar duration. To rebalance for dollar duration, we need to calculate the present dollar duration value based on the prevailing time to maturity, calculate the rebalancing ratio, and then take the new market value times the percentage change, and that will give you the amount that we need to rebalance. We don't do that exercise in this course. It's something I actually do talk about in one of our international finance courses. As well as the dollar duration, we can talk also about the spread duration. Essentially, spread duration measures the change in value relative to the benchmark of a 1% or 100 basis point change in the credit spread. Credit spreads change with change in the environment. When we expect things are going to get bad, the difference between the risk-free rate and a BBB bond will rise a lot. The difference between the risk-free rate and a AA will only rise a little bit. So we have much greater credit risk with low-grade bonds, and that's something that we also seek to manage. Again, we don't get into that into a lot of detail here. For that, we can take a look at using things like credit default swaps to try to manage that spread duration. This shows how the spread duration would be calculated based on our portfolio and a benchmark. Treasuries, of course, the difference between a treasury and a treasury is zero. So there is zero spread duration for our treasury instruments. For government agencies like crown corporations or municipal bonds, there may be a spread of 6.45%, at least in this textbook example. Financial institutions, 287 basis points or 2.87. Average industrials, across all of the different ratings, about 11%, utilities about 2.2%, and so on. So you can see that if we take a look at our portfolio, we have about 22% of our portfolio in treasuries, about 6.8% in those agencies, 6.2% in financials, 20% in utilities. We've got about 32% in mortgage-backed securities, mortgage-based bonds. Compare that to the benchmark. The benchmark has got a very different structure to their portfolio. Many of these things are the same, but when we take a look at industrials, they have a lot less exposure to industrials at only about 14%. And in fact, that's where most of the risk comes from. They've also got some asset-backed bonds in there, and they've got some mortgage-backed securities in there. And so that, on average, lowers the amount of their spread duration. And here, if we take the percentage of the portfolio times the spread duration for the benchmark and do the same thing for us, you can see the contribution to spread duration is higher for our investment than it is for the benchmark. In other words, we have more exposure to credit risk than our benchmark, if it's the DEX index or whomever. So this would be something that we need to be aware of. Now, perhaps that mismatch is part of our strategy because we're going to get a higher yield because we have more credit exposure. However, it's something that we need to know about. Some of the things that we also need to be aware of when we're thinking about managing our assets and liabilities, particular risks. Things like, remember asset liability management, we've talked about it before. How do we manage the difference in the timing between our assets and liabilities? So interest rate risk is going to be a part of that. Assets decline in value as interest rates rise, largely because of the inflation factor. So if we have to sell assets in order to meet a liability, our shortfall could rise. So if we have got bonds, long bonds, and they lose value, we're going to have to liquidate some of our bonds, and that could result in a shortfall. Contingent claims are claims that are going to be based on a contingency. So, for example, if there's a default from one of the in one of our investments, that could be a contingent claim. If there's early repayment requirements, that could be a contingent claim. So that's something that could stop the payment of an interest, stop an interest payment, and perhaps result in the partial default of a bond. And we have then inflation. We have a reinvestment risk, and we don't like to see our bonds being repaid early because reinvestment risk essentially means that we can't actually buy a replacement instrument at as good a rate as the one that we were forced to sell. There may also be some some limitations on interest rates that are created by contractual agreement called interest rate caps. Interest rate cap is essentially a limit that says that if interest rates go up by more than 1% in a year, then the maximum interest rate increase or yield increase will be 1%. If it goes up by 2 or 3, we're still stuck with 1%. So that's something else that we would be aware of as one of those limitations. Of course, we are very interested. Our principal interest is to to maximize our return. And within an immunized portfolio, we're limiting risk, but we're also limiting the upside. We're limiting the return. So our principal goal in buying insurance is to make sure that we don't have a catastrophic loss, but the more insurance that you buy, the less money that you're going to make. Pursuing additional return is often going to come at a cost of having less security, less immunization. So if we're thinking about the overall return that we need to get from our portfolio, if we say we need to get 5% or 7% rate of return, then that's going to come at a cost of being able to limit the amount of the immunization or the cushion that we can afford. So essentially, immunization lowers creates a lower bound or limit on the realized returns. It gives you a floor. It says you won't make less than a certain amount, but on the top end, it reduces the upside. In the next couple of sections, next video in particular, we're going to talk about how we manage risk within our portfolio, how we measure that risk, and how we use strategies like derivative strategies